Hello everyone. Today we're going to talk about how much money can you actually borrow on a house you're trying to buy. So here we go. Now the reason why I bring this up is because over my career it's come up a few times where there's kind of a logical disconnect as to what you're pre-approved to purchase and then what actually happens when you find a property and it might be like a different purchase price or you might be trying to get a different loan amount. But this has come up again recently, so I figured it was worth noting. Now what I mean by that is that when you are pre-approved before you shop, let's say you're pre-approved for $300,000, but then let's say you find a house for $280,000, but it needs some work. So you want to buy this house, but you tell me you still want the $300,000 that you're pre-approved for, so you could use the extra $20,000 or whatever that difference would be when you're already putting money down to do some repairs or do some changes to the house after the fact. Now logically, I could see why people might have that train of thought, is because you already know that you are pre-approved for a certain loan amount based on a purchase price and down payment, but you're already pre-approved for it. Now the thing is, where the disconnection is that what lenders are basing everything on is the value of the property, the value of the asset you're getting money loaned against. So it always comes down to what is the value of the property. And then lenders aren't going to lend above and beyond the value of that property and how that how your scenario was already worked out. It's always going to be based on the value of it. Now, are there some exceptions? There are when it comes to things like renovation loans. FHA has a 203K loan. 203K is just kind of like its indicator. A regular FHA loan is called a 203B, but no one really calls it that. So a different product that FHA has is a 203K, which is a renovation loan where you can actually get more money than what the house is presently worth to do some renovations to it through a contractor. And the hope is that the property is then worth a lot more based on putting a little bit into it. It's usually like cosmetic stuff, like doing a quick facelift to like the kitchen or the bedroom or a bathroom or something that's going to add value, but it's not a lot of work. You're not removing walls and stuff like that. But those products, if you're looking for a product like that, then look for a lender that is like, that's either all they do or that's their specialty. Because I'll tell you right now, out of the few I've tried doing, when they have come up, they're a total pain in the butt for the average loan officer because they're very different. They have a much longer time frame. There's a lot of different forms. It's just a different animal. And if you don't work with that sort of thing all the time, it's really not worth trying to figure it out, because then you can mess up your deal for your client as a loan officer. So as a consumer, I highly recommend finding someone who just does that type of product, or is just a specialist that knows how to do them very well. There's a few other programs out there, but honestly, I never come across them because they can be difficult to do. They can be difficult to deal with. You have to have a seller who's willing to not be in the house they're selling for a few months while there's being construction done on the house. So it's a very different animal to your typical just, I'm buying this house, this person's moving out and I'm buying it, and that's just how it is. But that's why I wanted to bring this up, because there are products that are like that, but lending is always going to be based on the value of the house. That's why when the value of a house comes in lower than what you agreed to buy it for, that's when you have to go into negotiations with the seller to either lower that price, or you have to come in with the difference of that money. So let's say you agree to buy a house for $300,000, it comes in at $290,000, and the seller doesn't want to budge. You could either cancel the escrow because the value came in low, and then go look for another house, or if this is the house you wanted, you got to come in with that extra 10 grand to close escrow. And not a lot of people have that or want to do that. So just kind of something to be aware of, is that it's always going to be based on the value. So anyway, wanted to keep it short today and just let everyone know that is something that comes up, but it's something to be aware of. If you're looking at properties that need work, if the property can get past the appraisal and the inspection, so everything is working and safe, so that it has all the pieces of the house are there, they just need to be updated. You might be able to do something like a home equity line of credit down the road, and maybe use that to help do some renovations. But as long as there's not safety problems like, oh, this house is missing some flooring, or it's missing some walls like drywall, or half this bathroom is not functional because the sink is missing or whatever, you can't really do much with that. Stuff like that happens a lot with bank-owned homes when you're buying foreclosure. So anyway, if you like this kind of content, please like the video, share it with others, subscribe if you haven't already, and I'll catch you next time. All right, peace.